Well, ISM data coming in this morning disappointing to the downside ahead of that key jobs report on Friday. This comes after data in February showed some signs of continued softening across the U.S. economy. Joining us now to discuss is Michael Gapen. He's the chief U.S. economist at Morgan Stanley. Michael, it's great to have you back here on the show. So talk to me just about how you are sifting through some of these conflicting reports, especially those that are showing maybe the fact that the U.S. economy is starting to weaken just a bit.
It's always difficult in these moments, but I think right now most of the data suggests that we're getting payback from a very strong fourth quarter, right? The biggest signal we've seen so far is that spending on durables retraced pretty sharply in January. Remember, auto sales were almost 17 million units on an annualized basis in December. So I think really there was a short-term demand for cars following the hurricanes last fall, and that should pay back. And it seems like it's paying back in the first quarter. So that, I think, is the majority of the story, payback, not turning point. But I think the ISM data that just came in does give you a little bit of an imprint of what tariffs and trade restrictions may do, right? So if that above 50 reading is driven by the prices paid component, remember back to COVID, higher prices paid pushed the headline on these indices higher, but these are indices constructed around demand side forces that would normally read stronger prices as stronger demand, pushing up producer prices, and that's not the case, of course, in this instance, right? So there's hints of tariffs would weaken both employment and activity by pushing up prices paid, and that's a soft data indicator. We have to see if it flows through into the hard data. So again, right now, I'd say payback more than turning point, but we have to be aware and alert for the turning point.
So Michael, what does that potential turning point look like? And how are you looking at the incoming data versus the incoming policy news out of Washington and sussing out which of those two buckets is going to be that turning point?
Right. So I guess when I say turning point, I'm kind of thinking, recession risk. And right now, I think the outlook is, manufacturing is a relatively small portion of the U.S. economy. It's about 10% of activity, 10% of employment. Trades, maybe let's call it 15% of GDP. There's a lot of overlap there between trade and manufacturing. So it's really, we're talking about a general slowdown in growth towards, something maybe to the 1.5% to 2% range from the 2.5% to 3% that we've been doing. So we're not saying that this is a recession, but if you put on trade restrictions, immigration restrictions, you try and act some spending cuts, it seems like the edge off the economy should be taken off and growth should moderate. So turning point here, I'm saying, what would be the recession scenario? And you need spillover from the good side of the economy into services. That probably comes through very weak asset markets, which would mean that upper income consumer, which has been spending and driving the recovery, would decide, hey, maybe we need to spend less and save more. So I think that would be your channel. Too much volatility, a big correction in equity markets, that might cause consumers to take a step back.
Michael, I guess, is there a higher probability or chance of that happening at this point, do you think, when you're taking a look at the data?
Sure. Given just the sheer amount of change across a number of policies, whether it's, again, trade, immigration, fiscal policy, geopolitics is an issue again. So there's a number of things here that could, and I emphasize could, we're not calling for it, that could collide together in a way that leads to risk-off sentiment. You get whiffs of it now and then. Again, our baseline is a moderation in the economy, a continued recovery in the economy, but we have to be watching out for signs that the combination of policy choices and heightened uncertainty lead to a greater pullback in activity than we expect.
Michael, you mentioned that personal spending for the top 10% of earners. They're responsible for half of U.S. consumer spending right now, according to Moody's. Do you think that makes the headline data look better than it actually is? Do we have the accurate data to suss out the health of the economy right now if that data is being held up by the top 10% of earners?
I do think we have the accurate data, right? So again, as an economist, we're writing down aggregate consumption, total growth in the economy, overall inflation. What you're pointing to is there appears to be a wide distribution of where households are seeing income growth or wealth growth and what that means for consumption. I think the way I would put it is the health of the economy or the robustness and the durability of the recovery is driven by a smaller and smaller share of households. That's not necessarily bad from a propagating the recovery point of view. But again, those are, as we're alluding to here, those are upper income households that hold the majority of the financial and real estate wealth in the economy. So if what that's saying is the major risk to the recovery is if all of this policy uncertainty collides in a way where equities say, we're 20% overvalued and we need a big correction. If you got that kind of correction, then upper income households aren't spending, the economy and the labor market weakens, and that's a very different story. So that's how I would interpret it.
Michael, one of the notes that you published a couple weeks ago at this point was titled Immigration and the Macroeconomy. And it caught my attention just because you mentioned the fact that obviously there's so much talk and rhetoric and focus going on when it comes to tariffs, that immigration is also potentially very consequential to the U.S. economy. I guess more specifically, what does that potentially look like, and what should investors keep in mind, especially as we head into the jobs report?
Yeah, I think that the story here is that tariffs get all the headlines and they're the bright, shiny objects in the in the news flow right now, and for all the reasons I think are right and we understand. But we're just trying to emphasize here that, remember, in the background is a very strong desire to control immigration flows that actually started in the middle of last year when the Biden administration took steps to control the border flow. Now, so I think we all agree that coming out of COVID, the surge in immigration put upward pressure on economic activity and brought in a lot more labor supply. So it took the economy to 2.5% to 3% growth, but also helped wage growth to come down and inflation to come down. So the supply side component here was very important. If we restrict immigration, go from roughly 3 million a year, like we had for 3 straight years, back to a million or less, something kind of below our pre-COVID averages, well, then shouldn't that narrative reverse? You have fewer spenders, fewer labor suppliers in the economy. So I think it can take immigration alone could take the economy from the 2.5% to 3% growth rates that we've seen in previous years, take it back down towards 2 or maybe even 1.5, if the combination of restricted inflows, some increased deportations, and maybe a chilling effect on labor force participation, weighs on the foreign born workforce. So I think we're just flagging that as, hey, don't forget, immigration is working under the hood right now. It's going to be harder to see in real time, but it should mean less growth in the labor force, less consuming households, and that will also pull growth lower.
So, Michael, I guess to put a bow on everything that we have talked about so far, it sounds like recession risks could weigh on asset prices, and if there's a sell-off to an intense degree in asset prices, then that could cause a recession. Can you help me understand the kind of feedback loop between those two things and which domino falls first to cause a substantial economic risk?
Yeah, so that's exactly right. And so the baseline view would be, well, trade restrictions, immigration restrictions, that should mean a slower growth, stickier inflation outlook, a Fed that cuts but cuts later. So the baseline isn't a recession, it's just a moderation in activity. But the risk is somewhere in here, maybe we push the policy levers too far, there's too much policy uncertainty, or it weighs on growth and employment more than we think. Then you get a stronger asset market correction and you get the reinforcing mechanism to lower consumption and recessionary outcomes. So it'd be more, at some point we've gone too far, asset markets correct, consumer takes a step back. Again, that's not the baseline, but that's the downside risk as we would see it.
All right, Michael, great insight as always. Thanks so much for taking the time to join us here this morning.